Chapter 4 deals with the auditing environment. The objectives for Chapter 4 are: define auditing, 2, describe the functions and benefits of auditing, 3, describe the regulation of auditors, 4, describe the effect of rulemaking bodies on the auditing profession, 5, describe the roles of materiality and risk in the performance of an audit, 6, explain the function of audit reports and describe the various types of reports. 7, describe the audit assertions and explain their importance. 8, describe the types of evidence gathering procedures used by auditors. 9, compare and contrast the types of audit tests. 10, explain the role of sampling in the performance of an audit. 11, describe the audit process. 12, explain the responsibilities of auditors and management with respect to the assessment of controls over financial reporting. 13, describe the auditor's responsibility to detect fraud. And 14, describe other services provided by accountants and auditors. I will say that this video will not discuss everything in the textbook. Therefore, it is your responsibility to read Chapter 4 for yourselves, okay? So, auditing, what exactly is auditing? Auditing is a process of gathering and evaluating evidence about information to determine the degree of correspondence between the information and the standards used to prepare the information. Fraud auditing usually uses a specialized approach and methodology to identify and detect fraud. That is, the auditor actively looks for evidence of fraud to prove or disprove that fraud exists. A fraud investigation usually encompasses the same thing as a fraud audit, except that an investigation typically involves a lot more non-financial evidence, such as testimony from interviews, than a fraud audit. So forensic accountants are often called in after evidence or suspicion of fraud has come to light, either through an allegation, complaint, or discovery. So Chapter 4 describes the auditing process and the role that forensic accountants can play in the determination of the fairness with which the financial statements depict financial position, results of operations, and cash flows of the company being investigated. Now, according to the Bureau of Labor Statistics, employment of accountants and auditors is projected to grow 6% from 2021 to 2031, about as fast as the average for all occupations. So about 136,400 openings for accountants and auditors are projected each year on an average over the decade, according to the Bureau of Labor Statistics. Now, many of those openings are expected to result from the need to replace workers who transfer to different occupations or maybe they exit the labor force, such as, retirement. Now, the demand for auditing arises because the providers of capital often are not directly involved in the daily operations of the business, and managers are usually compensated based on financial results that they report. Now, we will discuss the licensing, state-based regulation for CPAs, rulemaking bodies such as the PCAOB, SEC, FASB, GASB, AICPA, and the IIA in the following slides. So there are a number of rulemaking bodies that affect the auditing profession. Primary among them are the PCAOB, the Security and Exchange Commission, the Financial Accounting Standards Board, the Governmental Accounting Standards Board, which is GASB, the American Institute of Certified Public Accountants, and the Institute of Internal Auditor. Now, the PCAOB, which is the United States Public Company Accounting Oversight Board, is a private sector. It's a nonprofit organization, or corporation, I should say, created by Sarbanes-Oxley Act of 2002. And the PCAOB responsibility is, well, one of the responsibility is to oversee the auditors of public companies in order to protect the interests of investors and further the public interest in the preparation of informative, fair, and independent audit reports. The board is funded primarily by fees from public companies. The cost of processing and reviewing public accounting firm registration applications is recovered from registration fees paid by those firms. Now, the SEC, of course, is an agency of the United States, and it oversees the administration of the Securities Act of 1993, the Securities and Exchange Act of 1934, and other acts such as the Sarbanes-Oxley Act of 2002. Now, one of the mission of the SEC is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Now, the SEC strives to promote a market environment that is worthy of the public's trust. Established in 1973, the Financial Accounting Standards Board, or FASB, it is an independent private sector, not-for-profit organizations based in Connecticut. And that agency establishes financial accounting and reporting standards for public and private companies and not-for-profit organizations that follow GAAP, the generally accepted accounting principle. Now, the FASB is recognized by the U.S. Securities and Exchange Commission as the designated accounting standard setter for public companies. FASB standards are recognized as authoritative by many other organizations, including state boards of accountancy and the American Institute of CPAs, which is the AICPA. Now, the FASB develops and issues financial accounting standards through a transparent and inclusive process intended to promote financial reporting that provides useful information to investors and others who use financial reports. Next, we're going to talk about GASB. GASB, which was established in 1984, which is also called the Governmental Accounting Standards Board. It is the independent private sector organization that established accounting and financial reporting standards for U.S. state and local governments that follow GAAP. Now, the GASB standards are recognized as authoritative also by the state and local governments, state boards of accountancy, and the American Institute of CPAs. The GASB develops and issues accounting standards through a transparent and inclusive process intended to promote financial reporting that provides useful information to taxpayers, public officials, investors, and others who use financial reports. The Association of International Certified Professional Accountants, which is the association, they are considered the most influential body of professional accountants, combining the strengths of the American Institute of CPAs and the Chartered Institute of Management Accountants, CIMA, to power opportunity, trust, and prosperity for people, businesses, and economies worldwide. The AICPA, they are responsible for issuing auditing standards used to audit private companies. The IIA is an organization that provides guidance to internal auditors through the issuance of statements on internal auditing standards and the establishment of a code of ethics. Established in 1941, the Institute of Internal Auditors, or the IIA, is an international professional association with global headquarters, and the headquarters, I believe, is located in Florida. So the Institute of Internal Auditors, again, is that internal audit profession's global voice, recognized authority, acknowledged leader, chief advocate, and principal educator. Now, members work in internal auditing, risk management, governance, internal control, information technology, audit, education, and security. Wonder how I can get this away. There are two boards that are representative of those that affect the international auditing profession by issuing pronouncements and assisting in the harmonization of standards across countries. And that is the IIASB and the IASB. Now, the International Auditing and Assurance Standards Board is an independent standard setting body that serves the public interest by setting high quality international standards for auditing, quality control, review, other assurance and related services, and by facilitating the convergence of international and national standards. The International Auditing and Assurance Standards Board, or the IAASB, one of their objectives is to enhance the quality and uniformity of practice throughout the world. It issues international standards of auditing, the ISAs, practice statements that provide interpretations of ISAs and other assurance pronouncements. Now, according to the AICPA, the auditor has a responsibility to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether caused by error or by fraud. So because of the nature of the audit evidence and the characteristics of fraud, the auditor is able to obtain reasonable but not absolute assurance that material misstatements are detected. The SEC refers to auditors as gatekeepers. And therefore, the importance of their responsibilities with respect to the identification of risk of material misstatement due to fraud or fraud risk, and the detection of material misstatements in the financial statements due to fraud should not be underestimated. Again, the auditor's objective, one of the objectives, is to determine whether the financial statements are free of material misstatement, whether from error or by fraud. So what is materiality? Materiality, according to the textbook, is the magnitude of an omission or misstatement of accounting information that, in the light of surrounding circumstances, makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced by the omission or misstatement. Risk, or audit risk, is the likelihood that the financial statements will contain material misstatements after the auditor has determined that the financial statements are free of material misstatements. Inherent risk is the likelihood that an account or a class of transactions is materially misstated before considering the effects of internal controls. Control risk is the likelihood that the internal controls will not detect or correct a misstatement in an account or a class of transactions. And we will discuss risk even more further. So according to our textbook, the definition of preliminary judgment of materiality used by auditors is a very practical one. It is the amount of misstatements that could exist in a financial statements and not affect the decisions made by a reasonable user. Thus, if the author chooses an amount of $1 million as the preliminary judgment of materiality, The financial statements could be misstated by as much as $1 million and not be misleading to users. Determining a materiality level for the financial statements as a whole helps to guide the auditor's judgments in identifying and assessing the risk of material misstatements and in planning the nature, timing, and extent of further audit procedures. This materiality level does not, however, establish a threshold below which identified misstatements are always considered to be immaterial when evaluating those misstatements and their effect on auditors' opinion. So risk is at the heart of the reason that audited financial statements are required, particularly the risk that users will be harmed by making decisions based on incorrect information contained in the financial statement. I'll pause here. Trying to figure out how to get rid of this. Okay. Okay, components of risk. Now, auditors consider 4 components of risk: audit risk, inherent risk, control risk, and detection risk. Audit risk is the risk that financial statements are materially incorrect, even though the audit opinion states that the financial reports are free of any material misstatements. Audit risk may carry legal liability for a CPA firm that is performing the audit work. Auditing firms carry malpractice insurance to manage audit risk and the potential legal liability. Inherent risk is the risk posed by an error or omission in a financial statement due to a factor other than a failure of internal control. In a financial audit, inherent risk is most likely to occur when transactions are complex or in situations that require a high degree of judgment in regard to financial estimates. Inherent risk is one of the risks auditors and analysts must look for when reviewing financial statements, along with control risk and detection risk. Inherent risk is common in the financial services sector due to complex regulations and the use of difficult to assess financial instruments. Control risk or risk control is a set of methods by which firms evaluate potential losses and take action to reduce or eliminate such threats. It is a technique that utilizes findings from risk assessments, which involve identifying potential risk factors in a company's operations, such as technical and non-technical aspects of the business, financial policies, and other issues that may affect the well-being of the firm. So the goal is to identify and reduce potential risk factors in a company's operations, again, such as technical and non-technical aspects of the business. Risk control methods include avoidance, loss prevention, loss reduction, separation, duplication, and diversification. Detection risk is the chance that an auditor will fail to find material misstatements that exist in an entity's financial statements. These misstatements may be due to either fraud or error. Auditors may use the auditors make use of audit procedures to detect these misstatements. However, because of the nature of audit procedures, some detection risk will always exist. For example, auditors often sample a certain type of company transaction because examining every transaction is impractical. Increasing the sample size can reduce detection risk, but some risk will always remain. Some risk will always remain. According to the text, the auditor communicates his conclusions by issuing an audit report. The 5 primary audit reports are the standard unqualified report, unqualified report with modified wording, qualified opinion report, adverse opinion, and disclaimer audit report. Now, the first 4 of these reports are opinions, and as such may be referred to in this manner. The last, which is the disclaimer report, is a report that does not contain an opinion. So according to our textbook, the standard unqualified report contains the opinion that the financial statements present the financial position and results of operations according to a specified basis of accounting, and that no significant departure from that basis exists. An unqualified opinion is essentially a clean report. It indicates the auditor is satisfied with the company's financial reporting. It is the type of opinion most companies expect to receive from an independent auditor and reassures investors in the company that the financial information they have been given is presented in an accurate and fair manner. The unqualified opinion report is the most common type given in an auditor's report. A qualified opinion report is a statement issued in an auditor's report that accompanies accompanies a company's audited financial statements. It is an auditor's opinion that suggests the financial information provided by a company was limited in scope, or there was a material issue with regard to the application of GAAP, but one that is not pervasive. Qualified opinions may also be issued if a company has inadequate disclosures in the footnotes to the financial statements. An adverse opinion is a professional opinion made by an auditor indicating that a company's financial statements are misstated, and do not accurately reflect its financial performance and health. Adverse opinions are usually given after an auditor's report, which can be internal or independent of the company. An adverse opinion can seriously damage a company's reputation, plummet their stock price, or result in a delisting from trading exchanges. Accountants who deviate from GAAP should expect that at some point they will be looked at more closely. GAAP are put in place to ensure accounting compliance and transparency. Just because an accountant doesn't follow them, however, does not necessarily mean they will receive an adverse opinion. There are quantifiable effects of receiving an adverse opinion, but there are also effects like losing consumer confidence or business arrangements that can damage the business as well. A disclaimer expresses no opinion. It can be issued in any one of the following three situations. 1, the auditor is not independent. 2, the auditor could not collect an adequate amount of evidence to issue an opinion. And 3, the auditor is associated with financial statements of a publicly held company whose financial statements have not been audited or reviewed. The auditor should disclaim an opinion when the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be both material and pervasive. We will discuss audit assertions. So, when an auditor is handed a set of financial statements to audit, these financial statements contain information. Specifically, they contain audit assertions made by management as to the financial position, results of operations, and cash flows for the period to be audited. Assertions are nothing more than statements. So financial statements could have been termed financial assertions. The auditor recognizes 5 assertions in financial statements: presentation and disclosure, rights and obligations, existence or occurrence, completeness, and valuation or allocation. Together, they depict the financial state of the company and tell the story of what occurred during the audit period. Assertions are made to attest to the authenticity of information on balance sheets, income statements, and cash flow statements. Investors and analysts rely on accurate statements to evaluate a company's stock. FASB requires publicly traded companies to prepare financial statements following the GAAP companies must attest to assertions of existence, completeness, rights and obligations, accuracy and valuation, and presentation and disclosure. Now, one of the audit assertions in the financial statement assertion is presentation and disclosure. Now, this is the assertion that all appropriate information and disclosures are included in a company's statement, and all the information presented in the statements is fair and easy to understand. This assertion may also be categorized as an understandability assertion. Now, many professionals review and test sorry about that. Where did I leave off? Oh, okay. Many professionals review and test the authenticity of this assertion by using certain checklists. Now, it helps ensure that the financial statements in question comply with accounting standards and regulation. The assertions of rights and obligations is a basic assertion that all assets and liabilities included in the financial statement belong to the company issuing the statement. So put simply, the company confirms that it has legal authority and control of all rights, meaning the assets and obligation, which are liabilities, highlighted in their financial statements. The right and obligation assertion states that the company owns and has ownership rights or usage rights to all recognized assets. For liabilities, it is an assertion that all liabilities listed on a financial statement belongs to the company and not someone else, and not another company, and not in a third party. Now, if you want to test out the authenticity of this assertion, you can review legal documents such as deeds and borrowing agreements for loans and other debts. The assertion of existence or occurrence is the assertion that the assets, liabilities, and shareholder equity balances appearing on a company's financial statements exist as stated at the end of the accounting period that the financial statement covers. Put simply, this assertion assures that the information presented actually exists and is free from any fraudulent activity. And you can also test the authenticity of the existence of the assertion by physically verifying all non-current assets and receivables. For example, any statement of inventory included in the financial statement carries the implicit assertions that such inventory exists as stated at the end of the accounting period. The assertion of existence applies to all assets or liabilities included in a financial statement. The assertion of completion attests to the fact that the financial statements are thorough and include every item that should be included in the statement for a given accounting period. The assertion of completeness also states that a company's entire inventory or inventory that may be temporarily in the possession of a third party is included in the total inventory figure appearing on the financial statement. The completeness included in a financial statement means that all transactions included in the statement occurred during the accounting period. that the statement covers, and that all transactions that occurred during the stated accounting period are included in the statement. There are also tests that auditors can conduct to ensure completeness. Now, some of these include reviewing accounts and reconciliation of payables to supplier statements. And the last audit assertion is the valuation or allocation. The assertion of accuracy and valuation or allocation is the statement that all figures presented in a financial statement are accurate and based on the proper valuation of assets, liabilities, and equity balances. Now, this financial assertion states that different components of a financial statement, such as assets, liabilities, revenues, and expenses, have all been properly classified within the statement. And one of the ways to test this assertion is to redo all the calculations. For example, the assertion of valuation or allocation regarding inventory states that the inventory is valued in accordance with the International Accounting Standards Board, or the IASB, okay, which requires inventory to be valued at the lower figure of either cost or net realizable value. So next we'll go into evidence gathering procedures. Evidence gathering procedures. There are seven primary evidence gathering procedures that are available to the auditor. They are confirmation, observation, physical examination, reperformance, analytical procedures, inquiry of the client, and documentation. Audit evidence is the information you collect about processes related to the operations of a specific department within your organization. Auditors use this information to make findings about the department's compliance efforts and to prepare audit reports. One of the objectives of a fraud investigation is to gather evidence of a suspected fraud. To that end, forensic accountants might be engaged in a variety of contexts, such as one, agent of law enforcement, for example, FBI, the IRS. Two, member of an audit team, could be either internal or external audit. Three, private, meaning external. Okay. Four, private. Or did I mention private already? Okay. I think I did. So confirmation. What is confirmation? Confirmation is used when third parties, any persons who are not the audit client or the auditor, they have knowledge of some aspect of the audit client and can be asked to provide this information. Hold on for just a moment. Okay, sorry for the interruption. Just want to make sure I have everything. Okay. All right, so where did I leave off? Did I talk about confirmation? Confirmation. Confirmation is used when third parties, persons who are not the audit client or auditor, have knowledge of some aspect of the audit client and can be asked to provide this information. I think I did say that already. Anyway, confirmations are used to obtain information, and they can be used to obtain other informations, such as accounts receivable, notes receivable, investments, bank accounts, and accounts payable. There we go. The next one, observation. Observation involves the use of the senses to assess the propriety of employee performance and other activities such as business processes that have a tangible component, for example, assembly lines. Physical examination is the inspection of assets. For example, the auditor could examine an assembly line to determine the existence of equipment or a sample of vehicles by physically locating them by vehicle identification number. One example that I can think of is that when I worked in an academic hospital, I remember the external auditor wanted to actually uh, he wanted to actually inspect the assets, meaning equipments. He wanted to inspect the equipments. And one of the things that he looked for was to make sure that the medical equipments had what we call a VIN number, but in our department or my organization, we actually call it asset numbers. It's basically the same thing. It's the number that identifies the equipment, the asset. Reperformance. Reperformance is the act of performing a task that has been previously performed. It provides highly reliable evidence regarding how well the task was originally performed. For example, assume that an audit client's employee reconciles the bank account each month. So that would be something that an auditor would investigate to see if the employee actually reconciles the account every month, especially if it's supposed to be reconciled. Okay, the other procedure is the analytical procedures. Now, the analytical procedures are comparisons of recorded amounts to expectations developed by the auditor. I wanted to make sure that disappeared. For example, assume that an auditor audits a company in an industry that during the current year had experienced difficulties as a result of a downturn in the economy. Okay. The next one is inquiry of the client. It is a necessary procedure for obtaining information that does not exist in written form. For example, if the auditor determines with a high likelihood that an audit client will not continue to exist, the auditor may ask the client whether it has plans to decrease likelihood. Although written plans could exist, certain portions of them, particularly those still being formulated, may not be written. Inquiry of the client. And the last one is documentation. Documentation is the act of examining source documents. Okay. For example, auditors may select a sample of sales transactions from a sales journal and match them to sales invoices. An auditor could also inspect a contract that provides for the audit client's contingent payments. Documentation also occurs when an auditor opens a computer file and reads its contents. Those are the 7 evidence gathering procedures. Okay, tests, types of tests. Now, auditors may use several procedures to collect evidence. His or her objective determines the type of test used. The book talked about 4 primary types of tests: the test of controls, substantive tests of transactions, analytical procedures, and substantive tests of balances. Now, each of these tests is used for a particular purpose. Testing of controls or tests of controls. It is a procedure used in auditing to determine whether internal controls effectively prevent or detect material misstatements at the appropriate assertion levels. Control tests determine whether a policy or a practice is well designed to prevent or detect significant financial statement misstatements. As part of their risk assessment exercise, the auditor is required to obtain an understanding of the entity and its environment, including testing of controls. It is the responsibility of management to put in place a suitable system of internal control and to address identified financial statement risk, operational risk, and compliance risk. Effective internal controls, provided they are implemented properly, should ensure 1, reliable financial reporting, 2, the effectiveness and efficiency of operations, 3, compliance with appropriate laws and regulation, and the effectiveness of internal controls. Before the auditor can rely on the systems and controls that are in place, they must establish what those systems and controls are. And they have to carry out an evaluation of the effectiveness of the controls. Substantive testing procedures are substantive tests of transactions. Now, this includes tests of details and analytical procedures. Tests of details relates to obtaining source documentation and reconciling, tracing, vouching, etc. Analytical procedures relate more to using financial and non-financial information to derive expected balances and comparing to the actually reported balance. Substantive procedures are, again, the method of or audit tests designed by an auditor to evaluate the financial statements of the company, which require an auditor to create conclusive evidence for verifying the completeness, accuracy, existence, occurrence, measurement, and valuation of the financial records of the business. Analytical procedures. Analytical procedures are attention directing procedures. Now, their primary purpose is to determine whether an account balance or transaction is misstated. Instead, they often are used to identify balances and transactions that require further investigation. According to our textbook, substantive tests of balances, or simply tests of balances, provide evidence as to the correctness of account balances. Examples of these tests include confirmations of cash and bank balances and accounts receivable balances, as well as the comparison of recorded accounts payable with vendors' monthly statements. Sampling and the audit process. So what is sampling in auditing process, or what are the procedures? Sampling is the examination of less than the entire population so that a conclusion can be formulated about the population. Its objective is to determine whether a recorded account balance is fairly stated or a class of transactions was recorded correctly without having to examine the entire population. For purposes of GAAP, audit sampling involves the selection and evaluation of less than 100% of the population of audit relevance, such that the auditor expects the item selected, which is the sample, to be representative of the population and thus likely to provide a reasonable basis for conclusions about the population. So in this context, representative means that evaluation of the sample will result in conclusion that, subject to the limitations of sampling risk, are similar to those that would be drawn if the same procedures were applied to the entire population. Also, according to GAAP, sampling risk is the risk that the auditor's conclusion based on a sample may be different from the conclusion if the entire population were subjected to the same audit procedure. Sampling risk can lead to two types of erroneous conclusions. One, in the case of a test of controls, that controls are more effective than they actually are, or in the case of a test of details, that a material misstatement does not exist when in fact it does. The auditor is primarily concerned with this type of erroneous conclusion because it affects audit effectiveness and is more likely to lead to an inappropriate audit opinion. The other type of erroneous conclusion is that in the case of a test of controls, that controls are less effective than they actually are, or in the case of a test of details, that a material misstatement exists when in fact it does not. This type of erroneous conclusion affects audit efficiency because it would usually lead to additional work to establish that initial conclusions were incorrect. Sampling for attributes. Sampling for attributes is used when the auditor performs tests of controls and tests of transactions. It involves estimating the exception rate of the population based on a proportion or the sample of the population. The objective of sampling for tests of controls and transactions was to produce an estimate of the deviation rate. But the objective of sampling for tests of balances is to produce a dollar estimate of a difference between the recorded balance, which is the amount shown in the financial statement, and the amount that should have been recorded based on the sample. The next discussion is the audit process. And there are 7 steps. Plan and design the audit, performance of tests of controls and tests of transactions, performance of analytical procedures and tests of balances, completion of the audit and issuance of audit report. I'm sorry, I said that there are 7 steps, but the audit process, according to our textbook, mentions 4. But there are other resources that include 7 steps. And we will discuss this on the next slide. Okay. So the 4 are plan and design the audit, performance of tests of controls and tests of transactions, performance of analytical procedures and tests of balances, and completion of the audit issuance of the audit report. So a performance audit is nothing else, I should say, than it's an assessment. It's an assessment, right? A performance audit is an assessment of operations or functions, efficiency, effectiveness, and compliance to legal and other requirements of an entity to determine whether functions are working as intended. An audit is done to implement improvements so that the desired goals can be achieved. It is mostly done in case of the governmental associations and nonprofit making organizations. The audit process comprises 4 distinct yet integrated phases, which I listed a few minutes ago. But again, these are processes or phases that the textbook includes. Now, the first 3 phases, the plan and design the audit, performance of tests of controls and tests of transactions, and performance of analytical procedures and tests of balances, are chronologically performed. That is, tests of controls and tests of transactions are performed prior to performing analytical procedures and tests of balances. So the first step in the audit process is planning and designing the audit. Planning and designing the audit. Planning involves defining the scope of the audit and setting objectives. Now, this helps determine what needs to be examined and what areas need more focus during the audit process. It also helps establish timelines and deadlines, allowing adequate time to review all necessary materials. It is important for the auditor to understand the client's business processes, to understand the accounting policies, and also to understand the client's internal controls. Now, this helps to identify potential problems or areas of risk that may require additional attention during the audit process. Performance of tests of controls and tests of transactions. The auditor should design and perform tests of controls to obtain sufficient, appropriate audit evidence about the operating effectiveness of relevant controls if A, the auditor's assessment of risk of material misstatement at the relevant assertion level includes an expectation that the controls are operating effectively. That is, the auditor intends to rely on the operating effectiveness of controls in determining the nature, timing, and the extent of substantive procedures, or B, substantive procedures alone cannot provide sufficient appropriate audit evidence at the relevant assertion level. Performance of analytical procedures and tests of balances. It is, or should I say, are used here as a supplemental or the only procedure applied to the audit of accounts that have immaterial balances. And the fourth step that's included in your textbook is the completion of the audit and issuance of audit report. Completion of the audit and issuance of the audit report. In this report, after the 3 stages have been completed, the auditor must determine the overall rationality of the financial statements. In particular, the auditor must determine whether the financial statements, taken as a whole, fairly present the financial positions, results of operations, and cash flows in accordance with the basis of accounting specified in the footnotes to the financial statements. The result of this determination is a judgment as to the type of audit report, unqualified, qualified, that the auditor believes should be issued.